Welcome to The Explainer. Today, we are breaking down a truly incredible story about how one investor turned a bank balance of, well, basically pocket change into a multi-million yen portfolio. And this isn't about getting lucky. It's about a very specific strategy that anyone can learn from.
So our story begins right here with this number, 62 yen. That's about 40 cents in US dollars. This was the entire balance in one person's bank account. I mean, it is really hard to imagine starting any lower than that.
And this is how the person at the center of our story described his early life. It translates to a life beaten up by God, a feeling of just being completely beaten down by fate, as if every possible challenge was being thrown his way. And honestly, when we look at the details, you start to see why he felt that way. This journey, well, it truly begins at rock bottom. To really understand the powerful strategy that came out of this, we first have to appreciate the incredibly difficult circumstances that forged it. I mean, the deck was truly stacked against him. Academically, he really struggled, graduating near the bottom of his class. Then, financially, he enters the workforce right as the Lehman shock hits and his take-home pay just plummeted to less than 100,000 yen a month. And on top of all of that, he faced these unimaginable personal hardships. Now, this slide is really interesting because it just maps out the extreme volatility of his journey. From that low of 62 yen, he discovers investing, but, and this is key, it's not an instant success. He actually loses 2 million yen trying to do short-term trading. But then, just 5 years after that devastating loss, he hits 15 million yen in assets. So what on earth changed? So how did he turn it all around? This is really where this story shifts from hardship to hope. It all started with a single discovery that then became a repeatable strategy. The real catalyst was stumbling upon a well-known Japanese financial educator online, Ryo Gakucho. This was the moment everything changed for him. It wasn't about a lucky stock pick. It was about finding a philosophy and a system that he could actually believe in, and more importantly, follow consistently. So this brings us to this crucial concept of an asset explosion switch. Now, this isn't some get-rich-quick scheme. It's that moment you stop gambling and start implementing a disciplined, thought-out strategy. For him, this meant creating a two-part system that could balance safety with some pretty aggressive growth. And this brings us right to the core of his method. And you know what? It's surprisingly simple. He didn't just throw money at the market. He intelligently separated his funds based on where they came from and what he wanted them to do. And this just illustrates that separation perfectly. He took this stable, predictable income from his main job and put it right into the foundation of his portfolio, index funds. But the money he earned from his side hustles, money he considered his own risk capital, that was used for a much more aggressive strategy, picking individual high-dividend stocks. Okay, so first, let's look at that stable core. This is the bedrock of the entire portfolio, right? It's designed for that long-term, steady growth you get through broad market exposure. But the allocation here is pretty aggressive, even for the safe part. It's weighted heavily towards U.S. technology for maximum growth. A full 60% goes into indexes like the FANG Plus and NASDAQ 100. Then, to balance out that risk, 30% is in the broader S&P 500 for stability, with a final 10% targeting the high growth potential of emerging markets. All right, now for the second prong, the more active, higher risk part of the plan. This is where he uses his side hustle income to go hunting for specific opportunities in the Japanese market. And this is not random guesswork. He uses a really strict, data-driven checklist. He's looking for companies with a dividend yield over 5%, a sustainable payout ratio, and a solid market cap of over 100 billion yen. And here's the kicker. He wants industry leaders that are also undervalued, generally with a PE ratio under 15. The way he executes this is just as smart. He leverages Japan's new NISA program, which is kind of like a tax-free savings account, to keep all of his dividend income. And to manage risk with that side hustle money, he buys single shares at a time. This lets him diversify across many different companies without needing a huge amount of capital upfront. So you might be wondering, why the specific focus on Japanese stocks for the high-yield part of his strategy? Well, it turns out the timing lines up with some major economic shifts that are happening in Japan right now. For decades, Japan has been defined by deflation, a world where prices fall and cash is king. Well, that's changing. As inflation takes hold, just holding cash means your purchasing power is actively shrinking every single day. This creates a massive incentive for people to move their money into assets that can actually grow. And the appeal is driven by this really powerful mix of factors. First, Japanese corporate profits are at record highs. Second, the weak yen is acting like a massive tailwind for the country's exporters. And finally, despite all this success, many top companies are still considered fundamentally undervalued by the market, which creates a really unique investment opportunity. On top of all that, you have these powerful tailwinds pushing things forward. The Tokyo Stock Exchange is actively pushing these undervalued companies to improve their performance and deliver more value to shareholders. And as we mentioned, there are trillions of yen sitting in personal savings accounts that could start flowing into the market as people look to protect their wealth from inflation.
You know, the journey from 62 yen to 15 million yen wasn't about a single lucky break. It was about surviving the abyss, finding a philosophy, and then executing a disciplined, two-pronged strategy with conviction. It just proves that a clear plan is the most powerful tool an investor can possibly have. And that leaves us with one final thought to chew on. What's your switch going to be?